The world's largest silver exchange, COMEX, currently has about 103 million ounces of silver available for delivery. That's the metal that can actually leave the vault if someone demands it. Now here's the problem. In just 1 month, COMEX is staring down over 400 million ounces in open contracts. That's like having 100 pizzas and 400 very hungry people showing up for dinner. The math doesn't work. The first notice day for March delivery is February 27th. Write that date down. As I'm recording this, that's less than 2 weeks away. At the same time, COMEX vaults are losing roughly 785,000 ounces of silver every single day. I wish it were just 785 ounces, but it's not. Nearly 1 million ounces a day are walking out the door. So again, the math doesn't work. Something has to give. Whether you already own silver, you're thinking about it, or you just want to understand what's happening inside the financial system, the next 30 days could reshape metals pricing for years, and potentially the broader economy as well. You can't spell AI without metals, so even if you're a tech investor, this affects you. Today, Winston and I are going to show you exactly what's happening inside the vault, why March is the date everyone is watching, and how to position yourself, whether this thing blows up or quietly fizzles out. My name is Felix Pin. I'm a former investment banker. I've seen how this industry actually works from the inside. One of my mentors is a former London Metal Exchange market maker, and Winston is friends with many of the traders still active today. So you're not getting the sanitized CNBC version. You're getting the real mechanics of how these markets move and why they move. I'm also the founder of GOAT Academy, where retired Wall Street mentors teach institutional strategies to regular people, and the co-founder of Trade Vision, where we track the data and the news in real time. Our mission is simple. Take the same playbook Wall Street uses to profit, often at your expense, and put it directly in your hands. And right now, something serious is happening in the silver market that mainstream media is barely covering. They're too busy talking about the next meme stock or the latest headline circus. Whenever there's a circus, you should always ask, what are they distracting you from? And why? What I'm about to show you is not conspiracy. It's math. It's public data, straight from COMEX itself. And if you understand it, you'll be ahead of 99% of investors, instead of waking up in April asking, what the hell just happened? Before we go further, let me quickly explain what COMEX actually is, because most people genuinely have no idea. COMEX is the commodity exchange where gold and silver futures are traded. It's part of the CME Group, the Chicago Mercantile Exchange, and it functions as the official price-setting mechanism for precious metals in the United States and largely the world. Here's where it gets interesting. COMEX is primarily a paper market. Most participants never touch physical silver. They trade contracts, promises, and derivatives, not metal. Those contracts are usually settled in cash, not in silver. Think of it like a restaurant where 95% of the customers just exchange pictures of food, then leave without eating anything. That's the paper market. Now, COMEX reports 2 types of silver inventory, and this distinction is critical. First, there's registered silver. This is metal that is available for delivery. If someone stands for delivery, this silver can legally leave the vault. Second, there's eligible silver. This silver is stored in COMEX vaults, but it belongs to someone else. COMEX does not control it, and it cannot be delivered unless the owner decides to sell or re-register it. Eligible silver is like your neighbor parking his car in your garage. Yes, there's a car there, but it's not yours. Here's the trick COMEX likes to play. They often highlight total inventory, combining registered and eligible silver to make the vaults look full. As of February 2026, total silver inventory is over 400 million ounces, but that number is largely irrelevant. The number that actually matters, registered silver, roughly 103 million ounces. That's the real inventory. Everything else is noise. And here's where urgency comes in. Registered silver is down over 70% since 2020. That's the silver COMEX can actually deliver. At the same time, nearly 785,000 ounces are leaving the vaults every single day, and the pace is accelerating, not slowing. In 2020, registered silver was over 300 million ounces. Today, it's barely above 100 million. Ask yourself honestly, how long can this system continue? Now, I want to give you a simple framework for understanding what's happening and what comes next. We call it the VPP framework, Vault Pressure Positioning. First, the vault. We've established there are about 103 million ounces of deliverable silver spread across multiple vaults and custodians, with inventories changing daily. In January 2026 alone, nearly 50 million ounces left COMEX vaults. To put that into perspective, in all of 2024, only 6.8 million ounces were withdrawn. That's a 7-fold increase. The official explanation? Normal market activity. Right, just like your credit card bill being 7 times higher is normal spending. And it's not just COMEX. Shanghai silver inventories are at their lowest levels since 2016. The London Metal Exchange is sitting near historic lows. China has classified silver as a strategic material and imposed export controls. The United States has done the same. This isn't conspiracy, it's government policy. There's one more indicator most people never hear about, but it tells you everything you need to know: the silver lease rate. The lease rate is the cost to borrow physical silver. If there's plenty of silver available, lease rates stay low. If silver is scarce, lease rates spike. Why does this matter? Because anyone who wants to short silver needs to borrow physical metal. And when borrowing costs rise, shorting becomes dangerous and expensive. When you hear brokers advertising yield on your gold and silver, understand what's really happening. Your metal is being lent to traders, and you're being paid a fraction of what they're charging to borrow it. This is the same reason many brokerage accounts default to share lending turned on. It's quiet, automated, and profitable, just not for you. And right now, the silver lease market is flashing warning signals most investors have never been taught to watch. That's what we're going to break down next. If the person you lent your silver to goes out of business, what happens? It's gone. If you lend your car to your lunatic neighbor and he drives it off a cliff and it explodes, you don't still have a car. You have a story. That's it. And that brings us back to the silver lease rate, because this is one of the most important signals in the entire market. Normally, it costs less than 0.5% to borrow silver. It's plentiful. It's easy to find. Banks often lease the same silver out multiple times, but that's a separate conversation. Right now, the silver lease rate is 8%. 8. That means borrowers are willing to pay more than 25 times the normal rate just to get their hands on physical silver. That does not happen when vaults are full. It happens when vaults are empty and people are scrambling, but according to COMEX, everything is business as usual. I'm sure there's a perfectly reasonable explanation involving normal market dynamics or maybe seasonal adjustments. You know, the same phrase governments use when they massage their data. Either way, it sets off alarm bells. Now we move to the second part of the framework: pressure. March is a major delivery month for silver on COMEX. That means contract holders, the people who own paper silver, have the right to demand physical delivery instead of cash. Here's the issue. There are roughly 500 million ounces worth of contracts outstanding, and only about 100 million ounces of silver available for delivery. How does that even happen? How is that even legal? But that's the setup. Now think about this. If just 10% of contract holders say, "I don't want cash, I want silver," that's about 50 million ounces leaving the vaults. There are only about 100 million ounces in there to begin with. If 20% demand delivery, the vaults are effectively empty. You could host beautiful dinner parties in them, but they'd be useless for delivering silver. The first real moment of truth is February 27th. Write that down. That's the day traders must formally declare whether they want physical silver or cash settlement. Between now and then, silver is still leaving the vaults at roughly 785,000 ounces per day. Do the math. By the time we get to February 27th, another 15 to 16 million ounces are likely gone. Now here's another data point most people don't know. In February 2026, and we're not even through the month yet, the delivery rate is 98%. That means nearly everyone who can take delivery is taking delivery. So far this month, over 18 million ounces have already been delivered. These are not Reddit silver stackers. These are hedge funds. These are professional traders. They figured out something very simple. You can buy paper silver at paper prices and convert it into physical silver. Meanwhile, talk to most retail silver dealers and they'll tell you, "Sure, we can deliver in June or July." June or July. That tells you everything you need to know. So if you have enough capital in a COMEX account, the fastest way to get silver right now is to buy the paper contract and convert it. Why would people do this? Profit, greed, arbitrage. But here's my speculation, and yes, this part is speculation. Industrial users may be doing this too. If you're building massive chip fabs, AI data centers, robotics factories, you need silver, lots of it. You can go to miners and wait a year. You can go to traders and wait 6 months at a premium. Or you can go to COMEX and buy silver at today's artificially suppressed price. Why wouldn't you? Now the big question, what happens if COMEX runs out of silver? They have a few options. Option 1, cash settlement. They can legally say, "You wanted silver, here are dollars instead." Perfectly legal, completely destroys their credibility as a silver price setting mechanism. At that point, they're not a silver exchange, they're a dollar exchange with a silver logo. Option 2, rule changes, raise margin requirements, impose position limits, make delivery harder. They've already raised margins multiple times this year. We've seen this movie before. They can also phase out delivery-linked contracts entirely. And in fact, they've already introduced futures contracts with no right to physical silver at all. Just paper, just dollars. Option 3, paper and physical prices decouple. We're already seeing it. Physical silver in Shanghai is trading at roughly $40 above COMEX paper prices. In a free market, traders would arbitrage that instantly. Buy silver on COMEX, ship it, and pocket the difference. That's exactly what happened with gold in early 2025. But when physical metal becomes scarce, arbitrage breaks. COMEX's official position? Delivery issues are theoretical. In other words, we haven't run out yet, so stop asking uncomfortable questions. Now here's the part most people miss. Markets repeat. Not exactly, but the patterns rhyme. I've learned this from people who were actually there. In 1980, silver surged toward $50. The Hunt brothers had accumulated a massive position. What did the exchange do? They changed the rules. Silver Rule 7, liquidation only. You could sell, you could not buy. Silver crashed from $50 to $10, an 80% collapse. In 2011, silver again approached $50. CME raised margin requirements 5 times in 2 weeks. Each hike forced leveraged traders to sell. Silver crashed nearly 50%. Same pattern, same playbook. Silver threatens to break out. Rules change. Price collapses. But here's the critical difference. In 1980, COMEX had plenty of silver. In 2011, the vaults were full. In 2026, the vaults are nearly empty. They can change rules. They can raise margins. But they cannot create silver that doesn't exist. And that's what makes this moment different. Before we get into positioning, and which is the most important part, I want to share something with you. If you're watching this and thinking, I need to understand these patterns better, I put together a free mini masterclass breaking down how institutional investors actually trade these markets. It's short, practical, and completely free. You can find it at felix.org, get free. Link is in the description. I also publish a free daily and weekly metals newsletter. It's opinionated, data-driven, and focused on what actually matters, not headlines. Tens of thousands of investors read it. If you don't like it, unsubscribe. Simple, because what's happening now isn't chaos. It's the end phase of a pattern we've seen many times before. Now let's move to the final part of the framework, positioning, not financial advice, just how institutional players think about this setup. And it starts with one unavoidable fact. Silver has been in a structural supply deficit for 5 straight years, roughly 200 million ounces per year. Since 2021, the world is short nearly 1 billion ounces of silver, and demand isn't slowing. So are we allowed to write again? Let's see. Maybe typing helps. Maybe I'm banned from handwriting because it's genuinely terrible. People keep telling me that. Now, let's talk about demand, because this is where things get truly insane. A single solar panel uses roughly 20 grams of silver. Solar installation is growing exponentially, whether it's to save the whales, the dolphins, or just lower your electricity bill. Either way, demand is exploding. Electric vehicles use 5 to 10 times more silver than internal combustion cars. Then there's AI. And yes, you literally can't spell AI without silver. It's in semiconductors, electronics, data centers, and every advanced system being built right now. Total industrial demand for silver is around 700 million ounces per year, and it's growing fast. So the obvious question is, why don't we just mine more silver? We invest in silver miners, and sometimes they make us very good money. I've shared watch lists before, not recommendations, just starting points, including miners and ETFs you can track in TradeVision. But here's the reality. About 80% of silver is produced as a byproduct of mining other metals, primarily copper, lead, and zinc. Pure silver mines account for only about 25% of total production. That means you can't just turn on the silver tap. Even if silver prices doubled tomorrow, it would still take years to bring new supply online. And copper, lead, and zinc miners aren't going to increase production unless their demand rises significantly. That's the supply-side bottleneck. Now let's clear up something extremely important. Physical silver versus paper silver. Paper silver includes ETFs like SLV, futures contracts, and mining stocks. The advantages? They're liquid, easy to trade, no storage or insurance costs. No one breaks into your house to steal them. The disadvantages? Counterparty risk. You may get cash instead of metal. And in a market like this, paper prices may disconnect from physical prices, which is already happening. Physical silver, coins and bars, has no counterparty risk. You own it, period. But it comes with downsides: storage, security, higher premiums, lower liquidity. Now, the official line from the financial industry is that paper and physical silver are equivalent. That's true. Until it isn't. When Shanghai is paying a $40 premium for physical silver over COMEX paper prices, they are no longer equivalent. When dealers tell you delivery will take 6 months, they are no longer equivalent. Now, let me be very clear. I am not saying silver goes up tomorrow. The exchanges can change the rules. They can raise margins. They can cause short-term crashes. We've seen this playbook many times. The risk is that short-term traders get burned. Again, the opportunity, in my view, is structural. Vaults are nearly empty. The supply deficit isn't going away. Industrial demand is accelerating. Even if they paper over this for a month or two, the underlying problem remains. You'll hear analysts throw out numbers: $50, $100, $300 silver. I won't do that. Price targets are mostly clickbait. What matters is this. Supply and demand fundamentals are the tightest they've been in decades, possibly ever. So what do you actually do with this information? Step 1. Watch February 27th. That's the first notice day for March contracts. Watch how many contracts stand for delivery. If that number is above 75 million ounces, things get very interesting, very fast. Step 2. Track registered COMEX inventory. If it drops below 80 million ounces, the math becomes extremely uncomfortable for the exchange. Step 3, and this is the most overlooked signal, watch the silver lease rate. It's already around 8%. If that continues to rise, it's the market screaming that physical silver is scarce. Just like a borrow fee exploding on a heavily shorted stock, that's your warning signal. That's the framework. Verify what's actually available, not the headline numbers. Understand the pressure building. Then position yourself based on your timeline and risk tolerance. And let's talk honestly about that. Silver is highly volatile. It shouldn't be, but decades of paper manipulation have made it that way. Gold, in my view, is the steadier long-term asset. Silver moves like this. You have to ask yourself, can you live with that? If the last crash kept you up at night, stressed you out, or made you question your life choices, you have too much silver. Period. Position sizing matters more than being right. If 10% of your portfolio is in silver and silver drops 30%, you're down 3% overall. That might be tolerable. If 20% of your portfolio is in silver and it drops 30%, you're down 6%, and that feels very different. Every professional trader I know focuses on one question. How much of my capital is at risk? That's it. The exchanges will tell you this is a normal market. And technically, they're right. When the house always wins, this is normal. Of course, I would never accuse an exchange of manipulation. They are upstanding members of the financial industry, which admittedly isn't a very high bar. And I say that as someone who used to be part of it. If you want to learn how institutions actually read these markets, watch the free masterclass linked below at felixfriends.org/getfree. Join the Free Metals newsletter as well. We'll keep you updated as this unfolds. Winston and I will be here to break down the next round of Silver Madness. And I can promise you one thing, it's not going to get boring. All the best.